Hey everyone, this is Brad. So today I want to give you a little stock market news through the lens of rationality. So it was a crazy day in the markets, right? My portfolio was down almost 8%, Apple down almost 8%, Berkshire 6%. It's at a new one-year low. So there's blood in the streets, right? Or at least there's signs of blood in the streets happening very soon. So how does one capitalize on the stock market tumbling like this? Well, Warren Buffett once said, be fearful when others are greedy and be greedy when others are fearful. Now, clearly there's a lot of fear in the markets, right? The market is, I haven't seen Apple go down 8% in one day. I can't ever remember that happening. So one way to be greedy when others are fearful is to decide what you want to own. A stock is an ownership interest in a business. Now you have to keep that in mind. It's not a piece of paper to be traded if you're playing the long-term investing game like I am, like Warren Buffett is. So be greedy when others are fearful. What does it mean to be greedy? Well, decide what you want to own. What businesses do you want to own? And decide at what price those businesses are attractive investments to you. So that requires that you know how to gauge what a business is worth, and specifically what the fractional ownership shares of stock are worth in that business. So there's a few ways to kind of wrap your head around that. There's a guy, Aswath Damodaran, who's a finance professor at NYU. He puts out some amazing videos on valuing different businesses. You know, in the last year, he's valued Tesla multiple times. He's valued Google, Facebook, Amazon. You know, he values all kinds of businesses. He valued Uber, Pinterest, Beyond Meat, you know, a lot of different things. So one thing I recommend is to watch his videos, watch how he values businesses, and learn for yourself how to value businesses. And you don't need to be able to value a business down to the cent. I mean, it's not actually possible to do that, because valuing businesses, it's really about taking into account the probabilities of what's going to happen in a business over, you know, the useful life of the business, the effective life over the next 10 to 15 years, which are really the numbers that matter when you find the present value with the discount rate. Anything beyond 15 years, it's going to be so small in present value, it's effectively negligible. But just wrapping your head around how to value businesses. Another guy I follow, Mohnish Pabrai. So he doesn't really get into the details of how to value businesses, but he talks about companies that he's invested in the past and why he invested in those companies. And you know, he's not an Excel guy. He's not going to do discounted cash flows using Excel and very specific discount rates and all of that. He's looking for opportunities that basically hit him over the head with a baseball bat. They're so obviously attractive in terms of being a good investment. So I always look to see what he's buying and selling every quarter. That has to be disclosed in the US through 13F filings through the Securities and Exchange Commission. So actually one company that I've bought, I actually bought some today at $6.99, GraphTech. So he bought GraphTech probably about 6 months ago. And it must have been $10 or more, because that was the price. That was the lowest price looking back, you know, 4.5 months from when that 13F filing was released. And so I bought more at $6.99, which is clearly lower than what he bought it at. It's also held, it's actually owned by Brookfield Asset Management, which is another asset manager, Bruce Flatt, who's highly regarded in the value investing community. And my third kind of point of attraction for that company, what is his name? The Magic Formula, Joel Greenblatt. So he has a screener where he has two metrics in this screener. One is earnings yield, which basically is a metric for how cheap a business is. And then the other is return on tangible capital, which is a measure of how good the business is. And his screener ranks companies using these two metrics, and then it combines the two scores for each business. And so you have a screen that gives you the best combination of cheap and good. And GrafTech, I mean, it is in the top 30 stocks for every company that has a market cap over 50 million, which is a very big universe of businesses. So, looking at those 3 data points without even looking at the business, right? I'm very compelled by GrafTech, so I bought more today. But really, how do you make money in a stock market crash? The way that I see it is you don't short stocks. So say the market is crashing and you think, Carnival Cruise Lines, it went down almost 20% today. And I have a feeling it's going to go down more. So I'm going to short it. I'm going to ride the wave down. So that is a terrible way to make money in the stock market. The reason for that, when you short a stock, the best you can do is a double. The best you can do is double your money, okay? The worst you can do is go bankrupt, okay? If you short a stock and it goes up, if it goes up enough, your broker is going to say, okay, you have to put more money down because you've lost so much money on this bet already. I need you to put more collateral down. And that can just keep going on and on. So shorting is a terrible idea. Mohnish Pabrai, my mentor, says, as one of his 10 commandments of investment management, thou shalt not short. The risk to reward ratio is not something that's attractive to investors. So the best way that I see it to make money when the stock market is dropping is to figure out for yourself, what businesses do you really want to own? Over the long term, over 3, 5, 10 years, what businesses do you want to own? And then deciding, okay, at what price point are those businesses, are those stocks a good investment, right? Because you can't just decide, I want to own this business at any price. That's not a rational thought process as an investor. We have to know at what price is it a compelling investment. And that should be a price where your expected return on that, given the range of probabilities of what's going to happen with the company, is going to give you, for me, I'm looking to double my money every 3 years, right? So that would be a 4x over 6 years. So if I'm not in that ballpark, if I don't have a good probability of getting those kinds of returns, it's a pass. And for a given business, I can determine at what price the prospect of doubling my money in 3 years is a reasonable prospect, okay? So that's what I've done. I have a list of about 10 companies that I'd really like to own, and I have an idea about at what price can I double my money with those companies in 3 years. So that's really how I'm looking at making money from this correction. There's a lot of fear. There's a lot of people who are really concerned that it's going to keep going down, that the money that they already have invested in stocks is just going to disappear, right? I have money in stocks right now, and I'm not touching that money. I'm going to leave that because the companies that I invested in, I liked those companies at the price point that I bought them at. Some of them are down. You know, GrafTech, I think my average buy-in price was $11.50 for that. So it's down, what, like 40% right now? But that's okay because I was happy buying it at $11.50. That was a good deal. I still think it's a good deal at $11.50. So I'm not in a hurry to sell it just because the market says that it's worth $7 a share right now. You know, I don't take the market as my investment advisor. Okay, the prices of stocks right now, the prices that the market is saying, here's what we'll sell you this at. We're going to sell you, you know, Apple at whatever it is, $260. That tells me nothing about what the stock is worth. All that tells me is what people are selling it for. Okay. And as a long-term investor, it doesn't matter to me what the price is at any given time. I can wait until the market is offering me a more rational price for my assets, for my partial ownership in the businesses that I own. So that's kind of how I'm thinking about this crash. Other than GrafTech, there's not a lot yet that's a super compelling price to me. You know, companies that I'd like to own, Apple, Google, Facebook, those had such a run up in the last year that even with the correction in the last couple of weeks, a lot of them are nowhere near their 52-week lows. And I think based on all the fear in the markets, you know, every stock on my list, we could see new 52-week lows. So, you know, I'm waiting. I'm not seeing a whole lot that's a screaming buy at this point. And I'm hoping the market goes down more. Obviously, you know, I'm concerned for people who have all of their life savings in the stock market. That's unfortunate, you know, but, you know, at the same time, that was not a prudent investment decision for people who need that money in the short term. So, you know, while it is a shame for those people, you know, it's unfortunate that they didn't educate themselves more before making that decision. So anyway, guys, yeah, I'm hoping the market goes down more. I'm hoping some of the companies I really want to own go on massive sales. And I will definitely keep you guys posted about what I'm buying. But, you know, take a look at GrafTech. If nothing else, just to kind of familiarize yourself with what some of these super investors really like, especially at this price point. And it's an interesting story as well. So take a look at that. All right, guys, leave a comment below. Let me know what you're doing, if you're selling or if you're buying. And what's on your hot list? What can you not wait to get your hands on when the market goes down more? All right, talk to you guys next time.